Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Ryan Andrews. Thanks for being on the show, Ryan.
You're welcome. Looking forward to it.
Ryan is a managing partner of Ariel Investment Management, where he manages the recession-resistant real estate fund. Also helps manage the KYC Senior Debt Fund, an offshore fund that invests in private construction debt across the U.S. Altogether, he has been involved in managing 6 investment funds that have focused in both debt and equity. He lives in Bend, Oregon with his wife and 3 daughters and is an avid rock climber. So Ryan, thank you again for being a guest on the show. I'm looking forward to this because we don't have many guests who are experts in funds and managing a fund. And so I'm really looking forward to that conversation. So, but tell the listeners a little more about, what you're up to and just maybe your business a little bit, and let's dive in.
Sure. Yeah, happy to. Thanks for having me. So, I often pitch myself as kind of a fund guy or a fund CFO for projects. And so my background really started on the investment management side. I always wanted to get into real estate and be a developer. I grew up in Southern California and kind of knew developers and a little bit of what real estate development was. And then graduated college in 2007, right as everything was crashing. So there was pretty much zero opportunity to get into real estate at that time. So I just went into kind of regular investment management. I worked for PIMCO, the big kind of bond and investment manager, fixed income manager. And it wasn't until several years later that I was trying to work my way back into real estate. And that really started when I became an early employee with CrowdStreet. And maybe some of the listeners will be familiar with that platform, but it's a crowdfunding platform for commercial real estate. And so I came on as a really early employee and managed investor relations. And that started to get me back from kind of the regular finance side into the real estate side. From there, I actually left that and managed a debt fund or 2 different debt funds for a period of time. And that got me kind of familiar with how funds work and everything. And then most recently, so what I'm doing now with the recession resistant fund about a year ago, I joined up with a partner here in Bend named Mark Curry, who had a long background in syndication. And I saw what he was doing and we got to know each other. And I said, hey, why don't we wrap a fund around several of these assets instead of raising capital for them one at a time? Let's raise capital over a year, put 7 to 10 assets into a portfolio and hold those assets and manage it. And so that's just kind of a quick overview or survey of my background and how I got into the fund space and the current fund.
Nice. So, why don't you give the listeners a little more about, what a fund is and, why you might use a fund?
Sure. So this fund that we created, this current fund, is what's called a closed-end fund. So that means we raised money for a specific period of time, about 10 months. And then by the end of that 10 months or within about 30 or 45 days of closing the fund, it was fully invested. And so this is kind of a classic way that private equity or venture capital funds work, is you raise capital for a specific period of time, you invest that capital, and then you hold those assets and you're done. It's very different from a mutual fund, which probably a lot of people are familiar with, which is kind of taking money in and out all the time. And so when you think about a fund and kind of what it really is, it's basically just a bunch of pooled capital that we then turn around and invest in multiple deals. And so the benefit to the investors is they get diversification across several deals while they write one check that might be smaller than the check they would have had to write to get into all those deals individually. And so they get a lot of diversification. Again, similar to a mutual fund, you get diversification across companies in a mutual fund, but with this as a private real estate fund, get access to a lot of different deals that are professionally vetted and managed by myself and my partner. So we picked the deals, and the investors can join our fund at a smaller dollar amount than maybe they would have been able to join those individual deals at.
So smaller dollar amount. So there's not like a $50,000 minimum or $100,000 minimum. What would be the minimum?
Yeah, so the minimum for this fund was 50,000. So they were able to come into our fund at 50,000, but then once with their one $50,000 check, they got access to 8 deals, 8 investments that we put in the portfolio, and some of those had multiple properties in them. And so overall, our fund holds an equity stake in 50 properties in 13 states. So they got a ton of diversification with a small check. Whereas if they'd went and found those individual deals, they might have had to write $50,000 checks each for each of the 8 deals, or $100,000 checks for each of the 8 deals.
So that $50,000 investment is not going into one deal; it's being spread across all the deals.
Exactly. Yeah, exactly.
Okay.
And so,
go ahead.
yeah, go ahead. So when they came in, the early investors came into a blind fund. So they didn't know exactly what the deals were going to be. We basically outlined like, okay, this is our strategy and the kinds of deals we're going to pick. But they were kind of coming in on faith in us, or, their experience or background investing with us before. The investors that came into the fund later could see at least 4 or 5 of the deals that had already been invested in. And so our pitch to them was, hey, we're going to add 2 or 3 more just like those. So there was, some benefit to waiting. The early investors got a little bit of a kicker. We gave them some economic benefit to incentivize them to come in early and basically, take the blind fund opportunity.
So you mentioned a closed-end fund. So that means we have a timeline where you're going to say, okay, at this date, this fund is closed. Nobody can invest after that time. Is that correct?
Yeah, that's exactly right. And that's compared to what's called an open-ended fund, or a lot of times an evergreen fund, where investors can come in and out all the time. And so there might be a lockup period on an evergreen fund where you have to stay in it 1 year or 2 years. But after that time, if you want your money back, you can ask the manager and they give it back maybe within 60 or 90 days. That's really common for debt funds, like funds that are investing in debt, because the debt turns over a lot faster. And so there's proceeds to give investors their capital back, and then there's proceeds to get new capital from investors and put it into new debt, new private debt opportunities. With an equity fund like this, all of our properties we invested in for 5 to 10 years. And so if after 3 years an investor says, hey, I want my money back, we say, hey, your money's in this property. We're waiting for this thing to liquidate a couple more years. So there are a few ways they can get their capital back. They can sell it to other investors in the fund or the managers. But for the most part, they're locked up. And so that's part of a closed-end fund too, is you need investors that are willing to, stay in the fund for the length of all the deals that are in it. But then when a deal liquidates, we give our investors a portion of their capital back right away. So they don't have all of their capital tied up for the full, 5 to 10 years. They'll start getting it back in pieces as we go.
So when do they start getting distributions?
So we closed the fund on August 30th, and we issued our first distributions right after that, because we'd started investing in projects last January. And so we had a few that were starting to kick off distributions. So we just made our second distribution for the fund's second quarter earlier this week, actually. And so from here on out, it'll be quarterly distributions. But it basically started kind of around the time we closed the fund. We started making distributions.
Okay. So it was a 10-month period. And so if I invested, let's say in month 1 or 2, I was one of those first ones, when would I have received anything, during that time, or would it have been, after the fund closed?
It was after the fund closed. Our early investors didn't receive any proceeds for those first 6 or 8 months or so. And we were basically taking that capital, trying to source deals for it. And then once we even place capital, it sometimes takes a quarter for the underlying properties to start kicking out a distribution. And so there was a lag time there. Okay. And all the investors were comfortable with that and understood that process.
So what was the dynamic or the type of investors that were willing to invest, to say in the blind fund? I mean, it was, obviously it was blind because you didn't have any properties yet. They didn't know what they were investing in. Ultimately, they're investing in you and your partner at that point, right? I mean, exactly. They are anyway. Yeah. Were these people that you and your partner already knew? Or these people that, how did you get connected to those people?
Yeah, good question. So the initial set of investors were all people that we had previous relationships with. They'd either invested in previous funds that I'd managed, so they knew me or projects that I'd worked on, or they'd invested in previous syndications with my partner Mark. And so yeah, especially that first $1 million was all, friends and family money that we brought into the project. And then from there, once we had kind of a base, we started building new relationships. But even a lot of people with the new relationships said, gosh, we love what you guys are doing. Let's see how fund one goes. We'll invest in the next fund and all, because people like to see, they just love to build that relationship over time. And so we certainly saw that too. But yeah, overall, after we built the portfolio, or at least, 3/4 of the portfolio, it was much easier to work with investors that we hadn't met before that were new. They had some confidence because we could show them, okay, here's what we've done even in the last 6 months.
Yeah. So tell me about, or what was the limit on this fund? What was what were you trying to raise?
So this was a small fund. We raised about $2.5 million for it.
Okay.
And so yeah, we've got 20 investors in the fund. We're basically trying to raise a couple $1 million, up to $3 to $5 million, and invest it across 7 to 10 deals. So we ended up raising about $2.5 million, invested in 8 different projects. And so it was a great, kind of a great first fund under this brand.
And so what about the return structure for these investors in this fund?
Yeah, good question. So the return structure on the fund is actually really similar to a lot of the structures on a lot of the underlying deals. There's a management fee, a preferred return that accrues to the investors, even if they don't get all of it in cash at the beginning, the rest of it accrues. And then there's a profit split once the investors have met their preferred return. So the structure is very similar to all the underlying deals. And so the investors basically come in and say, hey, we're willing to pay some management fees and share some of the upside with the management team in order to gain diversification, to get and source deals that we maybe couldn't source on our own. And then hopefully have Brian and Mark as professional managers, that this is their job, pick better deals than maybe we would have picked on our own. And so that's kind of the trade-off is, we're basically saying, hey, in the end, hopefully even after paying our layer of management fees, you'll end up even or on top because you've got some risk reduction with the diversification, and then hopefully some better assets if we've picked them. So we'll see. Time will tell. Hopefully we've got some great assets in our portfolio.
Yeah. So I wanted to ask you too. So 10-month period, some investors came in when it was blind, and then others came in obviously later once they knew the types of deals that you all were investing in. And I just wondered, during that period, when did you see the most investors come in?
Yeah, good question. So it was basically kind of a barbell at the beginning and at the end. If you think of, 2 chunks. At the beginning, when we launched the fund, we had a lot of friends and family in our personal network that was excited, knew what we'd been working on for several months, and, jumped right in. And so that was great. Then the next biggest chunk of investors was at the very end, when we basically said, hey, we're closing the fund at the end of August. Last chance, last call for capital. And everybody that had been sitting on the fence and kind of waiting to see either said, all right, we're in, or now's not the right timing. So that kind of forced a decision. It was interesting through those middle months. It's difficult to create the urgency of why now? Why should an investor come in June? And so unless for them, they had some liquidity that they were like, I want to get this deployed. It was, we got people at the beginning and at the end. So yeah, that was how the capital came in. And I think that's more or less common. Fund managers are always trying to figure out ways to manufacture urgency to varying degrees. So sometimes that's, deals, we want to invest in this deal and it's closing soon. So any investors that are interested in come in now. Sometimes there's economic triggers. So you can put, anybody that invests in the first 3 months or 6 months gets a little bit higher pref or a higher profit split or something like that. We gave a higher preferred return to our earlier investors. And so that was an incentive for them to come in. But it was interesting. It was actually a dollar-based incentive. And so we said the first X million that came in got this higher preferred return. And so rather than putting a date on it, we put a dollar amount on it. And so everybody was kind of like, well, should I come in now or not? In the future, I'd put a date on it and say, okay, investors that come in before March get X, investors that come in before June get Y, and in order to incentivize people to make a decision and come into the fund, basically. So.
Yeah, I was wondering about what would incentivize an investor to come in at an earlier time, but you answered that. That's awesome. And I wonder too, though, an investor, so are they gaining any return? I mean, I know you said they're not getting a distribution, but if I invested in month 1 or 2, am I getting any kind of return, till it closes?
They are, yeah. So their preferred return starts to accrue. And so right when they invested, their preferred return started to calculate up. And so they knew, even though they weren't getting cash, their preferred return was accruing. And so they'd get paid out for that later. And so, yeah, the earlier investors, so everybody in the fund will earn the same, basic return. But the early investors will end up with more cash because they came in earlier. So their preferred return was compounding faster and more from an earlier date. And so, yeah, that's kind of the mechanics on that.
Well, what are some of the more difficult questions that investors may have that you have to answer when operating a fund like this?
Yeah, good question. So investors, of course, want to understand who we are and our background. They're investing in the people, whether they're early investors or the late investors. They're always investing in the people. And so a lot of questions about our background, where a deal flow comes from. Then quite a few questions on the structure of the fund. And that's something we spend a lot of time explaining to people, of how the fees work and performance fees work and the pref and what's the pref calculated, and questions just working through the structure of the fund. And we tried to create what I'd call a very vanilla private equity fund. It's a very common structure that's been used, forever, which is management fee, preferred return, and profit split above the pref, so that anybody that had invested in deals like this before had a good idea of what they were working on. We weren't, we didn't build in hurdle rates and flops and full catch-ups and all these different tools that starts to get confusing, because what we didn't want to create is, we didn't want to get to a yes with an investor that said, yeah, I love your guys' strategy, I like you guys, I'm in, send me the documents. And then they get our structure and they're like, whoa, this is so confusing, I don't get what's going on, I'm not going to write a check. And so we wanted to create as plain vanilla of a structure as we could, so that once we got to a yes with somebody, they were able to come in quickly.
Yeah, if somebody's confused, their answer is usually no.
Right. Yeah, exactly. Although they won't tell you no because I'm confused, because it's like a little embarrassing to say.
Right. If they can't understand it, they're probably not going to invest.
Yeah. Or they won't call you back, or they won't respond to your emails, and you'd be like, gosh, I lost, this investor. I don't know why, but maybe it was too complicated, or, they just didn't get it, but they didn't want to ask. And so, we try to spend a lot of time with investors explaining how funds work, because not everybody knows in the private space. You can't take it for granted that everybody gets how these funds work and everything. And then ultimately with the calculations, they're trusting the fund manager to do it right, and to make the right calculations and to make them whole. And so that's a big part of it. Another is, really in a post Bernie Madoff world where there's been fraud and everything, it's building that trust with people so that they want to know, hey, how do we know there really is real estate underneath this fund? And so we spent a lot of time, especially my partner jumped on several planes and flew around to assets in our portfolio. We took videos and talked on site to just at least show our investors, like, here's the assets that are in the portfolio. There's real estate underneath this, and inspire that confidence and get to know people, because again, it's trust. When people are, wiring you big chunks of funds,
yes,
it's really important to them. So,
and how do you get paid for running a fund?
So the management fee is basically what covers our, quote, overhead, which, is us managing our fund, receiving checks, turning around, sending out distributions, maintaining our relationships with sponsors and all that. And so we've got a management fee that's ongoing, that's paid out quarterly. At the same time as we pay out our distributions to investors. And then we've got a profit split on the back end. And so my partner and I, as like the managers, will get some of the upside if our projects perform well. And we won't see that for, 5-6 years probably, because even the first couple of properties that liquidate, the proceeds will really just go to catching investors up on their preferred return. That maybe, we'd been lower than their 8% preferred return for the first couple of years from a cash standpoint. And so, really our upside is having picked good deals and it's deferred to the end of the fund. And so it's a real long game for us as managers. But it's also a great tool. And you have a lot of guys that are syndicators, obviously, that listen to your show and everything. And so, maybe not a ton of them have been exposed to the fund model or even thought about a fund model. But it is a great, basically financial tool or financial product that some syndicators can basically use to build and, bring in a new investor group, invest across a series of deals, kind of earn some ongoing management fees and build that relationship. And then the hope, of course, is that by launching multiple funds, maybe a fund a year or every year and a half, over time, you build bigger and bigger funds and more relationships, and investors invest in multiple funds over time, and you kind of grow that fund assets under management.
So, when should I consider starting a fund of my own as opposed to doing individual deals, right? It's kind of like we're doing our individual funds for every deal. But,
right.
When should I consider a large fund like this?
Yeah, I think if there's some kind of benefit in the strategy that you can do, or maybe if there's like a lot of specific kind of deal flow that you're noticing coming in, if you're a syndicator, let's say, if you're noticing a lot of specific deal flow coming in for a certain type of apartments in a region, and you're like, gosh, wouldn't it be neat to do, 5 apartments in Atlanta over a year and put a small fund together that holds all 5 of the assets, and basically you can offer diversification to your investors. And so, for us, when we decided hey, let's put all these assets in a fund, we did it. And then we named our fund the Recession Resistant Fund because my partner and I were both looking at the macroeconomic environment and saying, hey, at the time, we're almost 10 years into the longest expansion in U.S. history. Now we're more than 10 years, or about 10 and a half years. And it is the longest expansion in U.S. history. And so we were saying, hey, what would we want to put, our parents or grandparents' money in to keep it safe through the next cycle? And what are good assets and assets that are likely to perform through the next financial crisis. And so we put together mobile home parks, self-storage facilities, and workforce apartments. We'd spread them across a lot of states. It's all institutional assets. So we're talking 100 units and more for each of these individual assets. And so we wanted to gain a little slice of equity exposure to a lot of projects, and projects that we felt like were most likely to perform in a downturn. So continue generating income is how we kind of defined performing. And so we felt like there was a lot of benefits from grouping those 3 asset classes together, putting as many of them as we could in our portfolio and trying to hold it basically from now through the next cycle. So that was our reason for putting the fund together.
All right. So just a few quick questions before we run out of time, Ryan. But what's the hardest part of running a fund?
Certainly raising capital is always challenging. You're going out, especially at the beginning, and selling a dream especially if you don't, as opposed to a syndication where you have an asset that you're looking at. When we were out selling a blind fund, we were selling a dream and a strategy and who we are. And then, just maintaining those relationships is super important, and maybe not hard in the traditional sense of, oh, that's a hard thing to do, but just something you got to stay on top of, spend time with your investors when, all of us are busy and you can get onto other things. So.
Nice. So how are you prepared for this potential downturn that everybody's talking about? I know this fund is called the Recession Resistant Real Estate Fund. So, how are you all prepared, for this potential downturn?
Yeah, so in this specific fund, we were really careful about the assets that we picked. We wanted to pick these assets that we felt like would maintain stability in a recession. And so we were looking for, mobile home parks have a tendency to do well in downturns because it's the most affordable kind of housing. And then workforce apartments also can do better or tend to do better depending on where they're located, where people will stay in apartments, choose not to upgrade or downsize to an apartment. These are definitely not luxury apartments. Again, it's what we call workforce apartments, which tends to be kind of $800 to $1,200 a month rent, something that a family can afford to live in, basically, with maybe one job or a blue collar job or trade skill. And so, and then all these assets also have a value add component. So it was important for us to feel like we could drive some appreciation, even if cap rates went the wrong direction or there was a downturn in assets or something. And then one thing we looked really closely at is what is the debt structure on each of our individual assets? Because debt in a financial crisis or in a downturn can be what kills you and forces you to be a distressed seller. And so we wanted to make sure we had fixed debt, or if it was floating rate, had a cap on it, went out for at least 10 years. So we knew like, hey, we can, we don't want to be trying to refinance in a credit crisis when everything is frozen and capital markets are frozen. And instead we have to sell our property at a bargain basement price. And so the debt structure was something we looked really close at. And then the geography, of course, was a place that, we wanted to be in places that we felt like had a good diversification of jobs. So, we'll have an asset, outside of Dallas, kind of garden style apartments outside of Dallas, Texas. We feel like, okay, that's a strong job center. We want to be commuting distance for families, et cetera. So those were some of the ways that in this fund, we tried to be prepared for a recession. That's something that's on my mind. I'm kind of an Austrian school of economics kind of guy. And so I look at all the, the quantitative easing that went on, all the, unprecedented monetary policy, and even what the Fed did in the repo markets in September by infusing, a ton of capital back in the repo markets. There's cracks in the system. And so, I'm just watching that carefully. I'm kind of a bear by nature. And I think it's because I graduated and started finance in 2007. So my first experience out in the working world was, this massive financial crisis. And so I'm kind of walking around, looking for the signs to see where it'll go. So we don't necessarily think there will be a recession this year, especially being an election year. But, when will it happen? Will it happen 2021, 2022? We'll see. It certainly can't imagine it going another 5 years or 7 years without a correction. So
what's a way that you've recently improved your business that we could apply to ours?
Yeah, great question. We spend a lot of time on our investor communication. And so we try and send out content pieces. We sent just earlier this week when we sent out distributions, we sent out a 15-page investor update that included an update of the fund, a 2-page macroeconomic update, and then a page or 1 to 2 pages including pictures and summaries of each of our assets and where they're at. And so trying to over communicate with our investors, send them a lot of content and touch them in a way that's not salesy. That's not like, hey, we're trying to run another fund. We're trying to raise another fund here. Where's your money? But instead saying, here's some content, here's how we're doing, here's what we're seeing in the markets. And so I just think that's a key way.
How often are you touching them, reaching out like that?
So we're sending our investor letter quarterly along with our distributions. And that's kind of our larger, thought piece that, we spend a lot of time working on. And then throughout the quarter, we'll send out typically 1 or 2 other just kind of pieces of content. And rather than sending out, weekly blog posts that we kind of put together quickly, we'll spend a lot of time talking through different aspects of what we see in the market or why we like certain asset classes or types, and send that content out. Just we want to be thought of in the minds of our investors as, wow, these guys are experts. They're on the cutting edge of their field. they're seeing great deal flow and keeping, staying in front of the different trends. So when it's time to invest, they're like, well, I'd rather put my money with these guys than pick my own deals, because these guys are really looking at, what's ahead. And so, those are some of our key things for businesses. And it's intuitive. Probably your audience all more or less knows that, but yet it's hard to sit down and actually spend the time to do it, because it's work that's important but not urgent. If you don't do it, nothing bad happens. But if you do it, over time, it generates good, returns in the sense of return on investment of time, basically, in those relationships.
So what's the number one thing that's contributed to your success?
Good question. I think relationships, and again, it's maybe a tried or obvious answer, but I realized, at some point in my career, more recently than a long time ago, that really my success and my income potential is directly tied to my relationships. All the deal flow, all the opportunities, all the customers, all the partners that I have are all sourced through relationships. And so, I'm at a point in my career, in my kind of back half of my 30s, where I'm just really focused on building and strengthening those relationships, and being ready for what's next.
And how do you like to give back?
Good question. Spending time with family is always super important. And trying to first, basically prioritize giving to my family before I'm even gone from them to give to somebody else. And so that's a top priority, spending time with my kids, and, kind of as a start there for local community. My kids are just starting to enter elementary school and such. And so we're starting to just get involved in, kind of the parent activities there and everything in the community.
Fun times, that's for sure. So Ryan, tell the listeners though how they can get in touch with you.
Great. Our website is Ariel Investment Management. That's AERIAL. They can also go to recessionresistantfund.com, and it'll push them over to the site. And anybody can send me an email as well. My email's on our website, but it's ryan@arielinvestmentmanagement.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.